Remember this? Back in 2022, inflation hit a staggering 9.1, the highest it had been in 4 decades. This wasn't just a number. It was a crisis that forced the Federal Reserve to slam the brakes on the economy with one of the most aggressive rate hiking cycles in history. Now, the big question is, what comes next? You've probably heard the term interest rates thrown around a lot, but what does it really mean? Think of it as the price of money. It's the cost of borrowing, and it affects everything from your car loan and mortgage payments to the stock market and the health of the entire global economy. It's the invisible force shaping your financial future. Right now, we're all caught in a high-stakes waiting game. After peaking in 2023, rates have started to dip. But don't be fooled, the ride is far from over. The market is incredibly volatile. On one side, you have home buyers and business owners desperate for lower rates to make their next move. On the other, lenders are cautious, unsure of where things are heading. This uncertainty creates a kind of paralysis, where everyone is just watching and waiting for a clear signal. But what's causing all this turbulence in the first place? It's not just one thing. It's a perfect storm of factors. Let's break down the three main drivers. First, there's the stubborn ghost of inflation. Even though the headline numbers have come down, the risk of another surge is very real. Certain sectors are still seeing price pressures, and the Fed is watching this like a hawk. Any sign that inflation is reigniting could force them to reverse course. Second, we have the Federal Reserve's own shifting strategy. For 2 years, their message was simple: hike, hike, hike. Now, their language is all about being data dependent. This means their decisions on when and how much to cut rates will be based on a constant stream of economic reports, from jobs numbers to consumer spending. This creates a lot of uncertainty because every new piece of data could change their entire plan. 1 month, a rate cut seems certain. The next, it's off the table. This unpredictability makes it incredibly difficult for businesses and consumers to plan for the future. And third, we can't ignore what's happening on the global stage. We're living in an interconnected world, and geopolitical events have a direct impact on our economy. Trade tensions, supply chain disruptions, and international conflicts all add layers of complexity. For example, tariffs can increase the cost of imported goods, pushing inflation higher and complicating the Fed's job. A conflict overseas can spike oil prices, sending shockwaves through the global economy. All these external factors are wild cards that could dramatically alter the interest rate landscape. Now for the key moment, the big pivot we've all been waiting for. For the longest time, the debate was about how high the Fed would raise rates. Today, that conversation has completely flipped. Inside those closed-door Fed meetings, the focus has shifted from aggressive hikes to a cautious, deliberate easing cycle. But here is the crucial part: do and expect a sudden drop back to the ultra-low rates we saw before the pandemic. Fed officials have signaled that they are planning only a handful of strategic rate cuts spread out over the next year or two, through 2025. They're tapping the brakes, not slamming on the gas. Their goal is to gently guide the economy to a soft landing without reigniting inflation. This means rates will likely settle at a level higher than what we were used to for the past decade. The era of nearly free money is over, and we are entering a new normal. So, what does this all mean for you? The peak of the rate hiking mountain may be behind us, but the journey down is going to be a slow and winding descent, not a steep cliff. The path forward will be filled with bumps, and it requires us all to be smarter and more strategic with our finances. Whether you're looking to buy a house, invest in the market, or simply manage your budget, careful planning is no longer optional. It's essential for navigating the economic landscape ahead. We'd love to hear how this is impacting you. How are these rate changes affecting your financial plans this year? Drop your thoughts in the comments below. And if you want to stay ahead of the economic trends that shape your wallet, make sure to subscribe and hit that notification bell. Thanks for watching.